there is danger of a loss. How do you address the losses? How do you reduce the risk? Three-pillar approach has been provided. Right? You are going to face a risk. Right? You are going to incur a loss. A three-pillar approach, a three-step approach has been approach. First one, capital adequacy ratio, CAR, capital adequacy ratio. And same, right? Under the first pillar, they say that the banks are facing a risk. In order to absorb the losses arising from the risk, maintain a capital adequacy ratio of 8%. And in the bracket of return, in India, it is in fact 9%. Why RBI has changed it? What is the second pillar? Supervisory review. Supervisory review. What do you mean by supervisory review? You are going to face operational risk, market as well as credit risk. Now, in order to minimize the risk, in order to reduce the impact of the risk, introduce new systems, introduce new techniques, introduce new processes. Is it okay? I'll repeat it again. You are going to face a risk. That's a fact. In order to reduce the risk, in order to reduce the impact of the risk, introduce new systems, introduce new procedures so that the risk will be reduced. That is called as supervisory review. That is referred to as supervisory review. And finally, market discipline. Market discipline. Now, what is this market discipline? Let me basically give an example. Many of you will ask me, and I've seen the questions already. Sir, I'm a bank. How will RBI come to know whether I'm following these guidelines or not? I know many of you have this doubt. Right? You are saying, right, issue shares, collect the money. You are saying, issue 81 bonds, collect the money. Have 9% capital. You are saying all of this. But how will RBI come to know? Will RBI governor come to my bank and start checking? Absolutely no. There is the importance of the third pillar, market discipline. What do you mean by market discipline? The banks will have to report all the data to RBI. Simple. The banks will have to keep on providing the input or the information to Reserve Bank of India. For example, if you want to issue 81 bonds, you'll have to take the permission from RBI, then issue. You want to cancel 81 bonds, take the permission from RBI, then cancel. You have issued shares and collected, right? Collected certain money, right? Then inform how much money you have collected, how many shares have issued, how much is the tier 1, how much is the tier 2 to RBI. So disclosures have to be done so that the regulator of the banking sector will know what you are doing. That is called as market discipline. Done. That is the market discipline. So one is the capital adequacy ratio. Second one is supervisory review. Third one is market discipline. Let me go to the third one. The concept of Basel III norms or Basel III guidelines. And we are implementing Basel III now. We are in the process of implementing Basel III norms. Right? Same question, sir. But how can RBI check the data for all the banks? My dear, RBI is a regulator. They will have systems. You don't worry. Right? Why do you think RBI has imposed penalties on so many banks? If you're reading the newspaper, you would have come across this. RBI imposes penalty on this bank. RBI imposes penalty on that bank. Right? How do you think they are able to do that? There are always checks and balances in the system. There are always checks and balances. You don't have to be worried about it. Now have a look at this Basel III round or Basel III guidelines. Right? The Basel III guidelines were announced in 2010. In India, we are in the process of implementing it. Capital adequacy ratio of 9%. Again, please understand this. Same three-pillar approach is followed here. Three-pillar approach is followed here also. I've not written all the three pillars. I've written only one pillar. Capital adequacy ratio. Right? One is a capital adequacy ratio. Second one is supervisory review. Third one is market discipline. All the three are there even under Basel III. But apart from this, right, what are the other very, very important provisions under Basel III which we are implementing? Under Basel III, they say that the tier 1 capital has to be at least 7% of RWA. I will repeat the statement. Under Basel III, they say that the tier 1 capital has to be at least 7%. More than 7%, very good. But at least 7% of RWA. Now, many will ask me, sir, why? Why focus on tier 1? Why nothing is there for tier 2? You tell me the answer. Is a tier 1 more reliable or tier 2 more reliable? You already know the answer. Is a tier 1 more reliable or tier 2 more reliable? Which can absorb the losses much more easily? Tier 1. The answer is tier 1 capital. So when tier 1 capital is more reliable, obviously they will tell you to collect more and more tier 1 capital. That is the reason the capital adequacy ratio is 9%. But out of the capital norms or out of the total capital that you're holding, tier 1 capital has to be at least 7% of risk-weighted assets. Second, capital conservation buffer. Right, capital conservation buffer. What is this capital conservation buffer? Let me start with the basic concept here. Buffer. What do you mean by buffer? Buffer simply means extra. Buffer simply means extra. Something that has to be kept extra like this. So why do we keep a buffer? Why do we keep extra? Let me ask you a very simple question. Will all of you save certain amount of money which you will keep in a secret place? Have you understand this? Will all of you save certain amount of money and keep it in a very, very secretive place? Right? Either it could be within your purse, it could be within one of the books which you will never open, it could be under all of your clothes, etc. My question is why? You tell me, right? Why do we do that? In fact, I also do it. You do it. Right? Look at your parents. They also do it. The argument is very simple. Sir, in case of emergency, in case of a sudden emergency, I should have certain extra money. During normal times, I will not use it. I want to order a pizza. I will not use that money. I want to go to a movie. I will not use that money. And some of you will say, sir, why only movie and pizza? I want to purchase a book. Not that money. But imagine there's a sudden emergency. That is, let's say, the salary is not yet credited, but I need money right now. Or there is a requirement for my friend. He needs money. Emergency is there. Only in such conditions, I will take out this particular money from the hiding place. And I will ask my friend to go out of the room so that, or my sibling to go out of the room so that they will not come to know where I've kept it. Will you not do this? Yes, even I do this. People do that. That's a normal behavior. So understand the logic here. What is this extra that we have kept? It is for emergency purposes. It is to be used only in certain conditions, not during normal times. Now follow the argument. Apply the same logic to a bank. The bank already has a capital adequacy ratio of 9%. Done? The bank already has a capital adequacy ratio of 9%. Now what if because of the pandemic, the losses are so high that this is not sufficient? Can it happen? Of course it can happen. I understand this. Can it so happen that in the market, the losses are so high because of operational risk, market risk or credit risk, the losses are so high that this 9% capital is not sufficient to absorb losses? Then what you will do? Then, right, basically, the Basel says, use the buffer. Use the extra capital that you have kept on the side. Just like you store money, you keep money in a hiding place, under Basel guidelines, the banks are also supposed to keep money extra like this. How much? 2%, 2.5% of risk-weighted assets. I'll repeat it. Just like you do. The Basel Committee tells the banks also to store additional capital, extra capital like this, 2.5% of risk-weighted assets. And the banks are not supposed to touch this capital during normal times. Imagine there's a pandemic. Imagine there's a crash in the banking sector, etc. In such cases, the banks are supposed to use the capital conservation buffer to absorb the losses. Because at that point of time, when there's a crash in the market, the losses incurred by the banks will be very huge. The capital adequacy ratio will not be sufficient. Now, you can use the extra 2.5%. Done? Right? So, this is capital adequacy ratio. Next, liquidity coverage ratio. Liquidity coverage ratio, LCR, liquidity coverage ratio. Let me start with example. Understand the concepts with examples, it becomes easy. Otherwise, if you stick to technical aspects, you will never be able to understand. Try to compare with the normal days, you will understand it very easily. Now, let's start. Let's start. Here is a bank. And imagine I'm that bank. Right? You will come to me and deposit 100 rupees. Okay? Right? You will come to me and deposit 100 rupees. Now, don't worry about CRR, SLR, not required. Focus on the concept here. Now, what will I do with 100 rupees? I will give it as a loan to a company. Done? I will give it as a loan to a company, let's say for 5 years. Now, what you have done, you have kept this 100 rupee as a deposit for 1 year. I will introduce one more concept here. Follow this very carefully. Right? You have kept the deposit with me for 1 year, 100 rupee. I have taken this 100 rupee, given it as a loan to a company for a period of 5 years. Now, is it okay if I start writing like this? This is a liability for the bank, and this is asset for the bank. This is a liability for the bank, and this is asset for the bank. Now, have a look at this. This is referred to as this situation. What is the situation? I've collected a deposit for 1 year. I've given this as a loan for 5 years. This is called as asset liability mismatch. Very, very famous. Very often you'll come across this in the newspaper. This is referred to as asset liability mismatch. ALM, asset liability mismatch. So why are we calling this as asset liability mismatch? The tenure of the liability and the asset are different. The tenure, again, I'm saying don't worry about CRR, SLR, don't worry, they are there. I'm not entering into the technicalities, simplified. The tenure of the liability and the asset, both are different, right? And because the tenure of both of them are different, right? Because the tenure are different, this is called as asset liability mismatch. Now, let me elaborate. Let me go forward next point. I have taken 100 rupee, given it as a loan. I will collect 100 plus interest in 5 years. But after 1 year itself, you will come to me and say, give me 100 plus interest. Now tell me, do I have a cash of 100 plus interest here? I will repeat the statement. Do I have right now, after 1 year is over, you will come to me and say, give me back the 100 plus interest, let's say 5%. So give me that 100 plus 5 rupees. Do I have the cash of 100 plus 5? No, I don't have it. Now, can this happen in the banking sector? Can it happen? Of course, yes. There are instances. It could happen. What can be done? Right? What should be done in such context? There is a ratio called as liquidity coverage ratio. There is a ratio called as the liquidity coverage ratio. Look at the statement first. I'll explain this. Liquidity coverage ratio simply means the banks are supposed to maintain certain high quality liquid assets. HQLA. I'll repeat it. The banks are supposed to maintain certain amount of high quality liquid assets. Why are those banks supposed to maintain high quality liquid asset? Let me elaborate on the same example. I've given this 100 rupees as a loan to the borrower, and the fact is I don't have 100, neither do I have interest to pay money to you. But what if I have government bond? What if I have a government bond? Now, under Basel guidelines, I will be selling the government bond, collecting the money, allowing you to withdraw 105 rupees. Is it okay? I'll repeat it again. I will be having certain government bonds. I'll be selling these bonds, right? Collecting the money and allow you to withdraw the money. Right? That is the basic idea of liquidity coverage ratio, LCR. But they've used the term ratio here. What do you mean by ratio? What the banks will have to do is they will have to estimate in the next 30 days how much money will be withdrawn. I will repeat it. The banks will have to estimate in the next 30 days how much money will be withdrawn. Estimate. And I'm pretty sure, right? Some of you will ask this question. I'm pretty sure. You'll ask me, sir, how will bank come to know how much money I will withdraw? It's not about you. It's about whole economy. I'll ask a very simple question. What do you think in the coming months? Coming months are October, November, and December. What do you think will happen to deposits in the bank? Will the people withdraw more money or less money? I have to understand the statement here. Let me check whether your people are reading correctly or not. Right? In the coming months, that is October, November, and December. What do you think people will do? Withdraw more money or lesser money? People will withdraw money. People will withdraw money. Sir, why? Festival. This is a festival season in India. October, November, December, festival season in India. Now, can I connect it to one more current affair? Some of you might have seen it. Many companies are saying the demand for their goods will start increasing in the coming days, so they've started producing more. For example, FMCG goods, fast-moving consumer goods, FMCG goods. Read the newspaper correctly, you'll understand all of it. Many companies are saying we expect bumper sales. And have you not seen many of the e-commerce companies announcing sales in the coming months? And understand the reason. Have you not seen many companies, big billion sales today, big billion sales week? Why? Why do you think they're doing it now? Why not earlier? Reason is simple, my dear. Festival is coming. During festival, people have the tendency to spend more. That is the objective, right? So keep on connecting the dots. What you learn here, what you see, connect the dots, you'll understand what is happening in the economy. So argument is simple here. The bank has to estimate next 30 days how much money will be withdrawn. Let's say hypothetically, the bank says we expect 100 crore rupees will be withdrawn in the next 30 days. Then the bank has to maintain high quality liquid assets worth 100 crore rupees. I will repeat it. The bank has to estimate in the next 30 days how much money will be withdrawn, how much cash will be withdrawn. And the high quality liquid assets which are supposed to be maintained should be equal to 100% of the money withdrawn. What is the reason? Reason is, by nature, these are high quality liquid. Understand my statement here. We have discussed the concept of liquidity already. By nature, these are high quality liquid asset. Means what? You can easily sell them. You can very quickly sell them in the market, collect the money. So that if the people are withdrawing money, the banks should have sufficient cash to allow for the withdrawals. Otherwise, what? Right? Imagine this situation will happen and let me know if you will accept it. You will go to the bank, you have received the salary, you will go to the bank and you'll say, please give me 50,000 rupees cash from my bank account. You have already received the salary, money is there in the bank account. You will go to the bank and say, Please allow me to withdraw. Not even please. I will simply say, here's the check. Give me 50,000 rupees. What if the cashier says, sorry sir, right now I don't have cash. Can you come back after 1 week? And let me know. If somebody accepts this, let me know. You simply say, who is your manager? Where is your manager? Call your manager, etc. Why? You're right. You're absolutely right. It is your money. You should be allowed to withdraw your money. But if there is a mismatch like this, can the situation arise where the banks will run out of the cash? Yes. And that is the precise reason under liquidity coverage ratio, they say that estimate next 30 days how much money you will need and maintain 100% of it in the form of high quality liquid asset so that you can sell these assets, generate money, collect money and allow for withdrawals. Done. So these are certain points regarding Basel 3 guidelines. Basel 1, Basel 2 and Basel 3 guidelines. Important for UPSC. Please be very, very careful. Next one, non-performing asset. Non-performing asset, NPA, non-performing asset. Now what is this non-performing asset? Follow this carefully. Assets are nothing but loans issued by the bank. Done. Assets are nothing but loans issued by the bank. Now, why do we call them as non-performing asset? Simple logic. Here is a bank. It has given loan to a customer. If the customer repays the loan, then this is called as a standard asset. I hope you understand this. I'll repeat it. Here is a bank. Bank has given loan to a customer. Customer repays the loan. Monthly interest will be paid. Principal is repaid. Monthly they will keep on repaying it. This is called as a standard asset. What do you mean by standard asset? The loans are being repaid by the customers or borrowers. But there could be another situation. What is the other situation? You have given loan to me. I am the customer. You have given the loan to me. After 2 months, after 3 months of taking a loan, I will stop making the payment. I will understand this. After 2 months or after 3 months of taking the loan, I will stop making payment to you. I will not make any payments now. Now, is this asset generating revenue for the bank? Let me know. Second example. Is the asset in the second example generating revenue for the bank? No. Hence the name non-performing asset. Hence the name non-performing asset. NPA, non-performing asset. Now, how these NPAs are classified? What is the definition of an NPA? Understand this very carefully. If the customer or the borrower does not repay for 90 days, I will repeat the statement here. If the customer or the borrower does not repay the loan for 90 days. So 90 days means what? Imagine on 1st of January, you are supposed to pay the amount. You must have seen loan EMI. On 5th of every month, every bank will have a loan EMI like this. So I'm just taking one example. On 1st of January, that was the last date. You are supposed to make the payment. That is, you're supposed to make a loan repayment. You will not do it. So what the bank will do? They will wait for 90 days. And after 90 days is over, from the due date, they will wait for 90 days. And after 90 days is over, they will classify this asset as a non-performing asset. Please have a look at the chart that I have given here. They will wait for 90 days. And after 90 days, they will classify your account as non-performing asset, NPA. So before 90 days, what they will do? Before 90 days, what were they doing? There is one more classification. Whenever you don't repay for first 30 days, I understand? 1st January was your EMI payment date. You did not repay. So from 1st January till next 30 days, for the next 30 days, they will classify you as a special mention account, SMA 0. They will classify you as a special mention account, SMA 0. And 30 days is over. Even now you have not repaid. So from 31st day till 60th day, they will classify you as a special mention account 1. And finally, 61 days, that is more than 60 days have passed now. So from 61st day to 90 day, they will classify you as a SMA 2. And even after 90 days is over, you have not repaid. Now they will classify you as a non-performing asset. Now many of you ask me, sir, why? Why this much amount of a circus? Why not directly classify as NPA? Even if you don't pay on 1st of January, 1 day delay is there, let's classify you as NPA. Why not that? It makes more sense rather than doing all of this circus. Now tell me, can there be delays because of salary payment? If you have a loan, you'll understand. If you have taken loan from someone, let's say from your friend, you would have promised your friend, I will pay it as soon as I get the salary. Pakka, next month as soon as I get the salary, I will make a payment. But what if your company pays the salary after 5 days? They're supposed to pay it, but there is an accounting issue, but they are paying it after 5 days. So you want to ensure that even if 1 day delay is there, you'll classify as NPA. No, that is not the right method. So you'll have to give certain time period, so that you can track the borrowers, find out if there is a problem, send them notices, etc. That is the precise reason we have special mention accounts. Is it okay? That is the precise reason why we have special mention accounts, SMA 0, SMA 1 and SMA 2. And after 90 days, even now you have not repaid, then RBI says, please classify these accounts as a non-performing asset. Classify them as NPAs. Now, what is the classification of NPAs? On what basis we are classifying them? What will happen if there is an NPA? What are we doing to reduce NPA? We'll take it up in the next class. Tomorrow's class, I'll pick it up from this very much slide itself. That is the classification of NPAs.